Hi, this is Tony D'Amico, founder and managing partner of Fidato Wealth. Thanks for joining me today for this video. In this video, what we're going to cover is our investment management philosophy and our philosophy and approach to providing comprehensive financial planning and wealth management. This video will also be very helpful for those, number one, wanting to learn more about us, and also for those that are about to attend their second meeting with us. That second meeting, we call it the analysis meeting, and that's where we're taking a close look at your goals and how you're positioned now and reviewing our analysis with you to determine if there's any gaps or opportunities and the overall strengths or weaknesses in the plan. So let me share my screen with you. Okay, so at Fidato Wealth, we do manage $277 million of assets for our clients. But as an advisory team, we operate under one unified philosophy. Okay, our consultative process, there's typically about 3 meetings that we have with somebody as part of our consultative process for a prospective client. And that's a great opportunity to learn if your plan is in line with your goals and values, if your investment asset allocation is optimal, if your comprehensive financial plan is solid, and again, if there's any gaps or opportunities that you have. So let's talk about our investment management philosophy, and we take what's called an evidence-based approach. So this first slide here shows you how the capital markets have rewarded long-term investors, and it shows you the growth of these 5 different parts of the market from 1926 up until 2020. And how if it's starting a value of $1, what it grew to during that time period. And this chart really reflects the research that was done by Dr. Eugene Fama. He actually won the Nobel Prize in economic science for his research, and he studied security prices going back to 1926 when they were first widely recorded. And he found a handful of items that were what we call statistically significant, or that there's evidence. So the first thing that he found is that stocks far outpace bonds in growth over the long term. So the 2 blue lines represent 2 different areas of the stock market. The 2 orange lines represent 2 different areas of the bond market. And this green line is inflation over that period of time, which came in just under 3%. So stocks outpace bonds was the first takeaway from his research. The second takeaway was that small cap stocks far outpace large cap stocks over time. So you can see $1 in the small cap market grew to 25,000 versus just 9,000 for US large cap stocks. So that was also considered statistically significant. So let's take a look at kind of the third factor, if you will, that he identified that was statistically significant. And that was that value stocks outpace growth stocks, again, over time. And what is a value stock? Let's start off here with large value. This is a US large company, and value basically means that you were able to buy that stock at a cheaper price compared to the value of the company. Whereas a growth stock is when you're paying a higher price to buy a stock compared to what the company is worth. So you can see large value stocks since 1926 have averaged just under 12%. And you can see large growth stocks at just about 9.9%. So that's a 2% difference. A core stock, a large core stock, you can say is a company that's fairly priced compared to the book value of the company. And you can see that came in at 10.27%. Now, the other, part of the return relationship is looking at the risk. So we have to look at both the risk and the return for these different asset classes. So you can see large value stocks have a standard deviation of 24.5%. So what that is a measure of sway, you can say, or volatility, you can say. So the larger that number is, the more sway that there is in the return. So ideally, we want to see the return to be as high as possible and that standard deviation to be as low as possible. So you can see there is more risk for large value stocks compared to, let's say, large growth stocks, but that risk has been rewarded for long-term investors. Another important point to note here is if you look at large core and large growth stocks, you can see their standard deviation or level of sway in returns is pretty similar, but core stocks have just about 0.5% higher rate of return historically, and expectation, that's what we use for expectations moving forward. So what we want to do with your portfolio is look at all of your accounts to see how they all work together and see what is that overall return and standard deviation that that we would expect for your portfolio moving forward, and seeing if that's ideal. Going on to US small stocks, you again can see small value, small core stocks have much higher expected rate of returns than large cap stocks, and especially small growth stocks. So, you can see here, small growth stocks have the same level of risk or comparable level of risk, let's say, as compared to small core stocks, but it's almost a 3% lower rate of return expectation for small growth stocks. So another thing, again, we'll take a look at is, again, how your portfolio is allocated within each account and also as an aggregate. So with bonds, again, here we take an evidence-based approach. The interest that someone earns on a bond is determined by two factors primarily. One is the length of the term of the bond, and the second is the credit of the issuer. Okay, so let's start off with credit ratings. We'll take a look at your bond portfolio, whether they're mutual funds, individual bonds. Either way, we'll be able to take a look at the credit ratings of your portfolio, and that's a really important thing to look at. So credit ratings are broken down into two different areas. One is investment grade. The second is non-investment grade. So you can see investment grade has a Standard & Poor's rating from a AAA down to a BBB. Bonds that are not investment grade are called high yield bonds, or they were once called junk bonds. So a lot of times bond funds will say it's a high yield bond fund. So high yield means it's paying out higher interest, but that is due to the credit rating. So you can see these credit ratings, the descriptor here is, the description ranges from somewhat speculative, highly speculative, most speculative, and down to default. So these bonds do offer higher interest, but there is more risk that comes with that. So we'll show you and educate you, again, what your bond portfolio looks like as far as the credit quality and the length of the term. Obviously, the longer the duration of the bond, the more risk that there is. So, and that is also very important because in a rising interest rate environment, if you have long-term bonds, the value of those bonds could drop more quicker if, again, you have long-term bonds. So very important. So bonds could be, conservative, or they could be aggressive to an extent. So markets are random and unpredictable in the short term. So what this slide here is looking at is the market returns from 2000 to 2010. So you can see the light blue line is the S&P 500. During that period of time, it averaged about -1% per year during that decade. So there was September 11th, there was the credit crisis in 08-09, and a patient investor, their reward would have been a loss of 1% per year. However, if we look at the orange line is the aggregate bond market. It returned 6.33% per year that year. So again, that kind of shows you what is a potential benefit of owning bonds. It's having that diversification and also that ballast against risk that comes with stocks. The dark blue line is, instead of being all US large cap stocks, instead of being that, it's 70% US stocks, but a mixture of large, mid, and small size companies, and having 30% allocated to international. And you can see that return during that period of time was 7.44%. So the reason why I'm showing you that is that shows you the benefits of being globally diversified and not just investing in US large company. So again, the role of global diversification, also the role of bonds. So being diversified across different asset classes is also another critical piece of your portfolio that we'll look at carefully with you. In this slide here, you can see from 2000 to 2020, it shows you what asset class performed the best down to the worst each given year. And you can see it's pretty much a checkerboard or a quilt, right? No one can reliably predict what asset class will be the best one given year. And often, for example, like real estate in 2006 was the top performer. In 2007, it was the worst performer. So that's not uncommon. So just making sure that you have that right mix, that right level of diversification across different asset classes, and then you know what the expected rate of return is and what that level of volatility is, and making sure that's an optimal relationship. So real investing is about going for a certain rate of return that you want to go for, but not taking any more risk than that's needed to achieve that rate of return. All right, so one of the last statistical things I'll talk about is called correlation. And I think this is really important because this is what creates diversification and then rebalancing or withdrawal opportunities. And what correlation is, it's a statistical measure of how two securities move in relationship to one another. So I've simplified this, but this dark blue line is US stocks. And we're comparing it to, in this case, the red bar is international developed stocks. So it has a correlation of 0.83. So what that means is 83% of the time that they will move kind of in the same direction, but 17% of the time, their movements could be random. And with emerging markets, you can see there about a quarter of the time compared to US stocks, they're going to be moving in a different or random direction. And real estate is that green line. You can see that, again, about half the time, real estate and US stocks move in a different direction. And then bonds was really the ultimate diversifier. And this is looking at investment grade bonds here, but 97% of the time, bonds and US stocks will move in random directions as compared to one another. They will not move in the same direction. So very important. And in a good portfolio, we want that, what we call that dispersion, where while some asset classes are doing well, others are not. And that's what this next slide here shows you is this shows you a portfolio that has about 15 different asset classes in it. And you can see, well, one is up 15%, others are down 15%. So let me kind of explain to you how this works while you're in the accumulation phase of your life and when you're taking distributions from your portfolio as part of your retirement income plan. So again, let's start off with when you're in the accumulation phase of your life, this dispersion creates the ability to, number one, rebalance. And number two is if you have capital to invest, right? When that is rebalanced into the portfolio, it will buy the positions that are down the most. Okay. And that's what threshold-based rebalancing does. It's a systematic way of ensuring that you're rebalancing your portfolio back to your target allocation. And when it does that, it sells the positions that have drifted high and are out of band, and it buys the positions that have declined in value and that are out of band to the downside. So that's what threshold-based rebalancing does. And it also, again, occurs when you're taking money out of your portfolio. So if a client was taking distributions from their portfolio this month and the account was rebalanced to free up the amount that they want for their income stream for that month, it's going to sell the positions that are up the most first. Okay. So strategic and disciplined threshold-based rebalancing does two things. One is it improves returns of a portfolio, and then it also decreases risk. Okay, so very important technique to utilize to further your wealth. Fees also matter. So we'll review your current fee structure and the different types of fees you're paying now, and we'll compare it to our fee structure. This Morningstar report that I like to use for illustrative purposes shows you this mutual fund, and it's the same mutual fund. The only thing that difference is the share class. So you can see an A share, B share, C share, institutional share, and then the version within a variable annuity. Now, if you go to this right side here, you'll see the 10-year rates of return are different. Now, it's the same fund, same manager, same underlying investment. But if you read the prospectus, the difference between these share classes is the fees and how they're assessed to the mutual fund, the person that owns the mutual fund shares. So you can see an A share has an upfront load, a B share has a back-end sales charge, a C share really doesn't have much of a back-end sales charge, but you can see the return is 5.55%. And that's lower than the A share return, lower than the institutional class share return. And then the share class within the variable annuity had a return of 4.04% per year over that 10-year period. So you can see that's a difference of about 2.8% between the variable annuity share class and the institutional share class. So the difference there in returns is not due to the difference in the return of the underlying investments. It's the fees that are paid to the financial intermediaries or advisors that have placed you into that fund. Okay, so we'll take a look at your investments and see what types of fees do you have. That's called a 12B1 fee, where you don't really see it come out of your account. It just reduces the return of the fund. And then also if you have any loads on your fund. Now, institutional class shares, often you don't get that full upside. You can see it's a 2.8% approximate difference between that share class and the lowest returning share class. Often to access institutional funds, you have to work with an institutional investor, and sometimes what they'll do is charge you a percentage fee to access those funds. So keeping your fees as low as possible, ensuring the fund quality is as high as possible, is part of the review that we do. So let's take a look at returns after investor behavior. So this was a study that was done by Morningstar and the John Bogle's Financial Markets Research Center. And they looked at the returns of this fund over a 10-year period. It averaged 10.6. The S&P during that period of time returned 7.1%. So it did do better than the overall markets, but investors in the fund during that same period of time, their return was just about -5% per year. So now you're probably wondering, how did that happen? Well, when they studied the flow of money into and out of that fund for that 10-year period, there was a lot of money that went into the fund in 07 and 08 after the fund had a fantastic streak. And then people sold off in 09 and never got back in. So people often buy high and sell low. And again, what we do for our clients is the opposite. It's long-term, it's disciplined, and utilizing, again, threshold-based rebalancing to do the opposite, right? We want to sell high and buy low. This is another study that was done by Dalbar over a 30-year period. It shows you that investors earned 4% while the overall markets earned 10%. So unfortunately, people do not do a good job often of managing their investments and managing it in light of volatility and those challenges that occur. So managing money can be emotional, and we want to take that emotion out of it once we have a solid plan in place based upon your goals and needs and lifestyle. So another common question I get is, well, Tony, are we going to head into a recession? And, I wish I had that crystal ball, right? But let's take a look at how recessions, how long they last. So these blue bars shows you how long expansions have occurred. The little red lines at the bottom here are how long recessions have occurred. So we can see that the average expansion lasts 67 months. The GDP growth is 24%. The S&P 500 has 117% return during that period of time. And there's about 12 million jobs added. Now, recessions occur, their average recession lasts 11 months. You can see we have about negative 2% GDP. The S&P somehow manages to squeak out a return, and there is a loss of jobs. So while recessions are painful, expansions have been much more powerful. So we also expect volatility. It's something that we expect and we take advantage of for our clients. So an example is going back to February 2020, when the volatility started to occur before COVID, really became a national issue where the lockdown started to occur. We started rebalancing our client accounts, and we rebalanced our client accounts a total of 7 times during that period. And what that did is it bought stocks as they were dropping. It sold the bonds because those were becoming a bigger part of the portfolio. And what that did is it averaged down our clients' cost per share in their funds. So very important to know. But we do expect volatility. And this kind of this shares with you here what volatilities look like from 1949 up till 2020. Let's take a look at what we expect for once per year. So on average, once per year, there's a 10% or more decline, and the average length to recovery is 112 days, okay? Gives you a good idea of what to expect being in the market. Now, that 10% or more decline is, again, if you're all stocks. So most of our clients are not all stocks. And again, that's part of the process, is to figure out what level of risk is right for you, what level of risk your financial plan needs to be successful as well. So we've talked about asset allocation and again, the roles of bonds. And this shows you when US large companies were down significantly in correction territory and how bonds performed during that period of time. So this really illustrates how high quality bonds have shown resilience when stock markets are in correction territory. And again, we're talking about investment grade bonds here in this slide. Market timing can also be very costly. So this is another 20-year period from 2000 up till 2020. It shows you what your return would have been if you invested 10,000 in the S&P 500. It would have grown to about 32,000. During that 20-year period, 6 of the best 10 days occurred within 2 weeks of the 10 worst days. So what do we know? Often, not always, but often the best days occur after the worst days. So if you just miss those 10 best days, so you were invested 20 years, but just minus those 10 best days, you can see it cuts your principal in half. So again, timing is impossible. And it can also be very costly. So these types of mistakes, if somebody does them, it really reduces their lifestyle the rest of their life, right? So another reason why that we do not try to time the market. The market also rarely returns the average. So this shows you the S&P 500 US large company returns, and it's averaged about 10% per year going back to 1926, but you can see it's a scatter plot. It's only returned about 10% about a handful of times, about 5 times. So if you're expecting let's say a 7% rate of return in your portfolio, you're often going to get something higher or something lower. But with time and discipline, the goal is that the averages hold. So when it comes to institutional investment management, the 3 primary managers that we use are BlackRock. They're the world's largest asset manager with about $7 trillion in assets managed. They have certain areas of the market that they do a great job in and have really demonstrated investment quality and consistent ratings. Vanguard is another fund company that we use. They're the 2nd largest manager in the United States with about $6 trillion in assets managed. They really revolutionized low-cost investing. And again, there are certain parts of the market that they excel in, but BlackRock and Vanguard are not obviously the best at everything. Dimensional is a third company that we use. Most of our viewers that are watching this video probably haven't heard of dimensional funds. So dimensional is only available through approved registered investment advisors and fiduciaries. So there's a process that we had to go through to be able to use their funds. And the reason why I would say that they're selective on who they work with and why they have a process or some steps that we have to take to be able to utilize their funds is, 81% of their funds have beaten their respective benchmark for the past 20 years. And that's compared to 17% of the overall investment landscape during that same period. So they're approaching 40 years being in business, and there's certain parts of the market that they don't have any close competitors that they excel in. And so we use each of these fund companies to their strengths. So there's about 300,000 registered advisors in the US, and a little bit less than 5,000 have approved access to their strategies. And we're very proud to be one of those firms that does. So let's take a look at why we use dimensional funds and why we just don't index or take a very passive approach. So what dimensional funds, and I'll illustrate that on the next slide, is they're instead of just buying the entire small cap market, like in this small cap fund, they're selective. They have selection criteria for them to include a stock in their fund. And so by utilizing a handful of criteria and screening out the larger index, their goal is to increase return, so do a little bit better than the index fund and either keep risk the same or reduce the risk. So you can see here, dimensional small cap fund up until 2020 here, average 10.3%. versus the index is just 9.3%. So that's a whole percentage point better just by providing some criteria on which stocks they purchase rather than just buy the whole index. You can see with large cap value as well, about 0.5% improvement in return. They also excel in international, emerging markets, and the bond market. So what dimensional does, as I mentioned, they utilize dimensions, or you can call them factors, and the stock or the bond has to meet these criteria, and the criteria have to be persistent. They have to be statistically significant. They have to be robust, cost-effective to administer as well. So for example, when it comes to a stock fund, they're going to look at the size of the company, the price that has to be paid to buy that stock, and what their profitability looks like. And so with these criteria, if the stock meets them, they will buy. If it doesn't, their portfolio managers have a very unique ability where they're given options where they can buy stock A at this price, or stock B at this price, or stock C at this price. So again, it's not active management where they're trying to guess where the market's going to go, making kind of large wholesale moves. They're applying criteria that have shown statistical significance to improve the pool of stocks that they're purchasing. And they do the same thing on the bond market as well. They'll look at the term of the bond and the credit rating, and they monitor bond holdings on a daily basis through a proprietary method where they can begin to see if a bond is starting to trade at a different price that might reflect a change in credit rating going down to non-investment grade. We also utilize Morningstar out of Chicago. They provide us with investment research and due diligence. And with that, let's jump to our approach to comprehensive financial planning. So, one of the things that we've always done is focus on providing our clients proactive financial planning, and doing that on a comprehensive basis, and blending in areas that include tax planning, risk management, estate planning, retirement income planning, and really leaving no stone unturned. Vanguard actually did a really good job in 2014. They released this really large white paper, And they wanted to study the value that can be provided if an advisor follows best practices. And what they found was that if an advisor follows best practices, they can add about 3% in net returns, or we can call it value, okay? So the dimensions are being an effective behavioral coach, utilizing an asset location strategy that has to do with tax efficiency, utilizing cost-effective investments, maintaining that proper allocation through rebalancing, and then also implementing a strategy, a spending strategy. So all of those factors combined is how they came up with that 3%. So very important and really comprehensive. Investment management is the fuel to your plan. Financial planning, however, is an area where you keep the plan moving in the right direction. And there's sometimes just as much value, if not more, that could be added to your bottom line by providing a thorough, comprehensive financial planning to maximize the available opportunities that you have. So we do focus on investment management, retirement planning, and that includes having a retirement income plan, Social Security and pension maximization, Medicare planning. We have a strong emphasis on tax planning. So it's not about what you earn, but it's about what you keep. So we refer to it as your net return after taxes. Risk management, that's really important, making sure that you are not taking any unnecessary risks. Estate planning. We also provide private trust services and corporate trustee services, as well as legacy planning, education funding, charitable giving, stock option management, executive compensation. But most importantly, it's ongoing financial plan management. So financial plans are based upon two sets of assumptions on how you think your life will unfold. And the other set of assumptions are economic assumptions. And so those are what we help you kind of keep on track year after year. So with our clients, we really become their CFO or their wealth manager. So internally, we have certified financial planners, investment advisors, insurance specialists, and then externally, we also work with CPAs, estate planning attorneys, again, private trust services, personal and business risk management, and other practitioners as needed. So what we really do is we spearhead the team of professionals that you need to, again, make sure that you're taking advantage of all opportunities and not taking any unnecessary risks that you have. So let's take a look at our core planning values. So we really believe in educating our clients so they understand their choices, the pros and cons with each of their decisions. And being fiduciaries, we give advice. So we're qualified to give advice and let you know what we would do if we were in your shoes. But we do think education is very important. We also want to bring organization to your financial life and get that organized both on a macro and micro level. Providing you objectivity, again, is another important thing that we do, being fiduciaries. Proactivity. So again, we want to create that base plan and then help you become proactive in light of your goals, help you be one step ahead of your goals and your best interests. Accountability too is another thing that clients rely upon us for. They want us to help them keep their plan on track, and they want us to help keep them accountable for doing the parts they need to. And this is a partnership. So we're really proud that we have over 95% client retention. We view this as a partnership. We view us as the last advisory firm that you'll ever need to hire. And it's a partnership that, that communication and collaboration is key to having long-term success and working together. So what we'll accomplish during your second meeting, we'll confirm our understanding of what your goals and what is important to you. We'll review your investments. We'll review our fee structure. We'll review our advanced wealth planning process. We'll also review your financial life plan and the probability of success. We'll determine if there's any gaps or opportunities, and we'll determine if we should set up a third appointment. So let's take a look at what that financial plan looks like as we wrap up. So a financial plan starts off with your goals. So here you can see this particular person wants to retire in 2028. They want to spend about $120,000 a year or so, and healthcare expenses on top of that. So those are some of their goals. And then we want to look at your resources. So we'll review your resources. In this particular example, they have Social Security. They also have investments and savings. And we review your net worth. That's another really important part of this process. And then lastly, the plan will give you your probability of success. So here, their current scenario had a 74% probability of success. So this gives you a probability of success between 0 and 99%. And ideally, we like the plans to be about 85% or more as far as having a probability of success. So these two other columns, risk profile 3 is moderate, risk profile 5 is aggressive. So why was this plan 74% and these other two jumping up in probability of success? So you can see here with their current portfolio, their return, expected rate of return was 7.15%, that standard deviation 16%. So with the moderate portfolio, they would actually expect a little bit lower rate of return net of our fees of 7.07%, but that standard deviation would drop significantly. If they wanted to keep the same level of risk, they could do so by moving to our aggressive portfolio, and we would expect a rate of return of about 8.5% for the long term. So in this particular case, they didn't want an aggressive portfolio. They were happy with a moderate portfolio, reducing the risk significantly and keeping the rate of return, basically about the same. So we can use, as we go through this financial planning process, there's other things too, besides just the portfolio that we look at to determine what would, increase your probability of success. It could be tax planning strategies, it could be risk management strategies, it could be Social Security claiming. All those different items are things that we look at. Wealth management for us, it's not just about money, it's helping you live that financial life that you want. Thanks for joining me today for this video. I hope you found it helpful, and we look forward to seeing you at your appointment. Thanks so much.